Today we're looking at an analysis of Rubrik's Q3 earnings.
A big quarter for them.
Huge. It focuses on their first ever non-GAAP profit, 10 cents a share, and this massive 48% year-over-year revenue growth. The report is definitely trying to capture a turning point.
Yeah, you can see what it's going for. Let's see how we can strengthen it right away.
Okay, so where do we start?
Well, the foundation is solid. The numbers are exciting. But to really make the financial narrative robust for, an expert audience, the analysis needs to do a better job contextualizing the sustainability behind that first profit headline.
Right. Let's dig into that. The material makes a strong case for efficiency. It highlights the 10-cent non-GAAP EPS.
Which absolutely crushed the estimate.
Crushed it. The estimate was a 17-cent loss. And it also points to that huge jump in free cash flow.
To $76.9 million.
Exactly. Giving them a 22% FCF margin. And the report presents this as proof, basically, that the company can now fund its own growth.
And look, those numbers are a really significant achievement, especially for a company that's, moving from that IPO hype phase into mature execution.
For sure.
But the report is a little light on the analysis needed to really prove this efficiency is sustainable. It says this marks a shift away from growth at all costs.
But it doesn't quite show the work.
It doesn't show the work. We have to ask, is that 22% FCF margin from something temporary? Maybe a one-off from deferred spending or some timing thing with compensation? Or is it actually a permanent structural change?
And that distinction is everything. For an analyst, the headline profit is nice, but knowing it's structurally sound is what matters for the long term.
Precisely. So the suggestion is to weave in a brief, high-level structural analysis, something that validates that FCF margin.
How would you do that?
You could do it by referencing industry benchmarks. That gives you external validation. Or another way is to explore the potential headwinds. What could threaten their new full-year FCF guidance? That kind of analytical tension, it adds real weight.
Okay, but how do we do that external validation without access to, their competitors' private data? It feels hard to definitively say if 22% is structural from the outside.
You have to rely on comparative relevance. So one really strong approach is to compare that 22% margin to other successful SaaS companies.
One's growing at a similar speed.
Exactly. Rubrik's subscription ARR growth is 34% year over year. You find peers in that zone, framing that 22% not just as a good number for Rubrik, but explaining if it's exceptional or maybe just average for that specific growth stage adds so much depth.
Ah, I see. So it answers the unasked question. Is this good for them, or is it actually good, period, against the best in the business?
You got it. That's how you move from just observing success to understanding its caliber.
Okay.
And another lever to pull is the product mix itself. The analysis has to ask how the successful cyber resilience and the new AI security products affect future profits. Is this positive income mostly from cutting costs?
So efficiency from the expense line.
Or is it being driven by a better product mix? Products with inherently higher gross margins. Pinpointing that is crucial for figuring out what happens next.
Right. Because if the new AI stuff has way higher margins, then that 22% FCF is much more sustainable and scalable than if it just came from keeping a lid on costs.
It shifts the whole discussion from just celebrating a number to truly understanding the engine behind it.
That makes sense.
And this all leads us pretty naturally to the growth drivers themselves, which brings up the next area for refinement.
I was thinking the same thing. The discussion of growth drivers would be a lot more powerful if the surge in business was more explicitly tied to the key financial metrics, especially that record net new ARR.
Let's look at that section. The material correctly highlights the demand for cyber resilience and the early wins with AI security.
And it says these things are driving the addition of 23 new whale clients.
Right, the $1 million a year customers, which all added up to a record $94 million in net new ARR.
It's all laid out clearly, but I wonder if the connection between those drivers and the final number is really established. It identifies what is driving growth.
But it treats the $94 million as just one big number, a result of general success.
Yeah.
And for a sophisticated report, that's a missed opportunity. You could try to infer or even model the specific impact of the new AI products on that record ARR versus their core recovery platform.
So that's the analytical gap. An investor wants to know about the quality of that ARR.
Exactly. Is that record $94 million mostly from cross-selling new products to existing customers? Or is it from landing brand new enterprise clients?
So the suggestion is to introduce some kind of analytical framing that models the relative contribution of those different growth engines.
It's about turning that general market enthusiasm into a data-supported conclusion about where that $94 million is actually coming from.
Okay, but that feels speculative. I mean, for an external report to try and assign a percentage to a cross-sell model, aren't you risking being wrong and undermining the analysis?
It's a fair point, but a core function of this kind of analysis is to provide informed inference when you don't have the granular data. We're not saying these are facts.
You're providing a framework.
We're providing a framework for evaluation, using the public data we do have. For instance, the material mentions the AI security offerings, so you could frame the analysis around a cross-sell into their existing $1.35 billion ARR base.
Okay, walk me through what that would look like.
Sure. The analysis could say something like, assuming a successful adoption rate of, say, 5% of the existing customer base migrating to the new AI platform, that would hypothetically account for X% of the record $94 million in net new ARR.
I see.
It gives you a tangible baseline for the success of that new product and lets you assess how much of the rest is coming from new customers or core product expansion.
That's super specific and actionable. It turns market excitement into a number you can actually test your own assumptions against. And another angle is to focus on those whale clients, those 23 new million-dollar-plus customers.
Okay.
The analysis should explore what's driving those specific deals. Is it the core cyber recovery platform? Or are these big contracts conditional on them also buying the new integrated AI stuff? Because if the AI component is mandatory for those big deals, that tells you a very different story about future growth.
A completely different story. It forces a strategic interpretation of the data, which is exactly what a high-level analysis should do.
Okay, so we need deeper validation of profit and clearer links for growth. Now, what about the presentation itself, the tone?
Yes, the tone. We need to calibrate the language to maximize the report's rigor and, its objectivity for financial experts. The descriptive language needs to be carefully balanced with the standard tone of institutional analysis.
I definitely noticed that. The report uses some very vivid phrases like cash flow explosion, hypergrowth, and it describes the stock move as a breakaway gap, signaling a new, sustained bullish trend. It really conveys excitement.
And the excitement is warranted. That profit was a huge surprise. But is there a risk that by focusing on these high-impact words, you actually dilute the analytical weight?
How so?
Well, the 48% year-over-year revenue growth is massive. But the more critical metric for a SaaS company, subscription ARR growth, is a still great but lower 34%.
Right.
Calling both hypergrowth and calling the FCF jump an explosion, it starts to lean more towards advocacy than objective analysis.
So the language could make an experienced analyst a little wary, make them question if the risks were fully explored. It creates a bit of an analytical distance.
That's it exactly. So the suggestion isn't to kill the passion. The data is exciting.
Of course.
It's to just shift the tone slightly. Make sure every single one of those high-impact words is immediately backed up by a hard quantitative benchmark or some comparative context. That grounds the analysis in data, not just sentiment.
So if we pull back on words like explosion, how do we make sure the analysis still conveys the sheer scale of this turnaround? You don't want to undersell it.
You use comparison as your tool. Look at the conclusion about the stock price, for example. Instead of saying the results justify the plus 22% re-rating,
Which is subjective.
it is. You frame it as a comparative analysis. That makes the statement instantly more defensible.
So something like, the combination of 34% ARR growth and positive FCF reestablishes Rubrik's premium valuation, justifying the recent price move relative to its high-growth SaaS peers.
See? A huge difference. It turns a subjective conclusion into an objective comparison based on market principles. The excitement comes from the data itself, not the adjectives.
And what about that technical language, the breakaway gap signaling a sustained bullish trend?
Same idea. It needs similar calibration. Present the breakaway gap as one possibility, a strong technical signal, yes, but not a guarantee.
So you hedge it a bit.
You just add context. Briefly note that while the company's financials support the move, external market conditions like risk appetite in tech or interest rate forecasts could still affect the long-term trend.
That small acknowledgement of macro risk provides the intellectual balance an expert audience is looking for, even when the news is this good. It reinforces the analyst as an objective interpreter, not a cheerleader.
That's the goal. Maintain the exciting narrative while demonstrating the highest level of analytical rigor.
This has been a really focused critique, and I think it will maximize the impact of what is already a strong report. To sum it up, the key themes are all about enhancing analytical depth.
Right.
So that's contextualizing the financial efficiency, creating clearer causal links for that record ARR, and finally, just aligning the tone with high-level financial rigor.
And the actionable summary is this. First, validate the sustainability of that 22% FCF margin. Put it in context against peers and figure out if it's cost control or product mix.
Okay.
Second, connect that $94 million net new ARR directly to the new AI products. Use some informed modeling to suggest where it's coming from. And third, make sure every exciting, high-impact word is immediately balanced by a number or a benchmark.
Exceptional feedback.